Hello, everybody. We are about to start our investment show.
Sorry about that.
Okay. Uh, we start this investment show actually on Wednesday when there is a startup show on schedule. And it's very interesting to compare investments to startups. Basically, investment, and I'm talking about primarily stock and derivative investment. Derivative, I'll explain very soon. It's basically instruments that derive from stocks. So if you have a stock, and then so when you are buying stock, you're buying a piece of the company, even if it's 1 billionth share of a company, but you still own a small piece of a company. Derivatives are what derives from stock. You don't own anything. What you own is the financial instrument that can appreciate or depreciate in price. Depends what instrument we are talking about. What's talking about startup? So people have different ideas that they would like to do. They would like to start a business. Most likely, they will have to invest some money. They will have to market this business. They need inventory, most likely, to sell. They have to market whatever product they're selling. They have to hire people. They probably have to rent an office space or do it from home. And once, even if they are successful, it's becoming some kind of a routine where they have to watch inventory, try to increase their sales, fire people who are not fulfilling their promises or obligations, and then find new people. And after a couple of years, it's becoming just a routine, which you'll be lucky to sell to somebody and just run away from it all. Um, our stock market is a peculiar animal. It's always existed, at least for the last 300 years. Probably it will exist for another 7,000 years. It's always available. It's always there. It's there now as we speak, and I'm watching some of my investments from time to time. It will be there tomorrow. It will be there next week, next month, and even next year. So we really have to. You need two things. You have to have a talent to be successful stock market investor. Absolutely. You need an aptitude for doing that. People who have both, they are going to be successful, very much successful. Some of them will be extremely successful beyond any reaches. Some of them will do well enough to satisfy all their needs, their family. Now, because I don't know my audience, I don't know really where they are, who they are, what their talents, aptitudes. It's a guess game on my part. But I'll do my best, and I'll hope, I really do hope that people get something interesting to themselves. If nothing else, just enjoy yourself and maybe you get some useful information. Now, let me just tell you that I'm not a registered representative of any kinds. I'm not working for anybody at all. I'm independent investor, uh, chess historian, and philosopher. Everything what I'm telling you and going to tell you, it's coming from me only, and I'm the only one who is responsible for that. And I will also read to you some of the authors of different financial publications whom I 100% agree and whom I regard very, very well in investment business. And from time to time, I will discuss with you my investment technique and what I'm doing. And not only position that I'm involved right now, but why I initiated this position, for what reasons, what's happened when I initiated it. Mm, but what I'm not going to do, I will not going to give you any investment advice, what to buy and what to sell, or so on. And I'm not going to be therefore responsible for any investment decisions, whatever you will make as a result of our program. So let me start from recommending some reading, which may inspire you to learn more about investment. Maybe if you don't have a talent and or aptitude or both, maybe you will try to find just a bit to develop it, and maybe you'll become interested. I'll do my best, not promise you anything. However, let me start with this. This is a book by the name Reminiscences of a Stock Operator by Edwin Lefebvre. Very important thing. Uh, Annotated edition by John Markman. Not only that, it also has a preface which was written by, or should I say, forward, which was written by no other person as Paul Tudor Jones, his chairman and chief executive of Tudor Investment Corporation. Supposedly, he is probably the most successful stock and futures investor of all time. Mm, Arguably, okay, maybe some people would consider John Buffett or Warren Buffett, sorry. However, just a couple of days ago, I saw on CNBC clips about a day trader who claims that he is many times more successful than Warren Buffett, and how much money he's making, and um, it's kind of refreshing to hear something like that, even if you disagree with that. But the well-known strategy of holding your stocks forever, like Warren Buffett did most of his life, with Coca-Cola and with American Express and so on, I don't think that it really works in today's markets. I will later tell you why. However, what I'd like to do, I'd like to read you foreword by Paul Tudor Jones. Here's what he wrote. I first read Reminiscences in 1976. So we're talking about 44 years ago. It was given to me by my first boss and the most important book I could read. It resonated with me on a variety of levels. First, Livermore started with but a few coins in his pocket, and as a relatively penniless 21-year-old, when I first read it, it was both reassuring and hopeful. His stories of making millions hobnobbing with other great financiers and stock market operators, trading from a yacht, and deftly maneuvering through the great commodity and stock corners of the day was the financial equivalent of sex, drugs, and rock and roll to a young man at the advent of his financial career. Secondly, his facility with numbers was very familiar to mine, very similar to mine. It was as if he spoke straight to my soul in this regard. Finally, probably the greatest message I took away from the first read had to do with understanding price action. There are times when every market has a story to tell, and you have to train yourself to be both a great observer and listener, or you will be too late to enjoy the full story that will be told. I have read the books countless times in my career, and I cannot remember a single time when I haven't discovered something new. As I was reading it again for umpteenth time, I noticed on page 3 it reads that Livingstone used to journal both the determination of probable price movements as well as a sorted record of my hits and misses. I have been doing this semi religiously for the most of the past 3 decades, and I always thought it was my own invention. Over the years, I guess I deluded myself into taking credit for a brilliant practice integral to my success by conveniently forgetting the inventor. And, and this points to why this book is so important to me and why anyone looking to take up trading as a profession should read and study it. It is a textbook for speculation. Indeed, I had a copy of every new trader to have, regardless of his or her considerable experience. I'm always looking for the next Jesse Livermore. This is what wrote Paul Tudor Jones. I don't think anybody can argue with the words of wisdom from a great investor and speculator and trader. Now, let's speak about a little bit about investing, speculation, trading, gambling, and all that stuff. Sometimes people have different meanings of that. But let's talk about investing. What is actually investing? Why are we talking about that? Investing means that you would like acquire a piece of property, shares in the stock market, or a piece of art, or just anything that you believe will grow in value in next foreseeable future. It could be 25 years, it could be 2.5 years, could be 2.5 hours. Depends. If you bought a picture and you paid $10,000 and you're living auction house and somebody offers you on a spot $15,000 with that, some people will decline, some people will sell it right on the spot. So they will generate 50% investment profits in a matter of a couple of hours. It's not so bad, not so bad. So let's see if you bought a stock, shares of. I recently purchased some General Electric, not that it's a great company, but I thought that there is some potential maybe to appreciate a little bit in value. So let's see if I paid 6.50 a share, and half an hour later somebody will pay me $7. You know what? I probably will sell. It's very quick profit, about 8%, 8.5 for a couple of hours. Yeah, I think I'll take it. Yeah. Some people would prefer to hold on longer to that. I immediately have to notice that never ever get married to your stocks. The stocks are to be bought and sold. There is no mystery to it. It's a faceless piece of a company. You have nothing to do with the business of that company. You don't love that business. You shouldn't ever thinking about that because it will ruin your profitability, and you have to have a very, very open mind. That includes another thing. Don't trust nobody. All the financial publications, your television shows, it's a bits and pieces of noise that you can listen to. You can use for your own judgment what to do with this noise and this bits and pieces of information. But it's your money, and only you can make decisions and should make decisions what to do, what to buy, what to sell. And you are the only one responsible for your decisions. That's what makes a very interesting bridge from investments, from stock market to chess, because chess is always a game where you are fully 100% responsible for your decisions, for choice of moves, and ultimately for result of the game. So if you lose a game of chess where you see the board just as your opponent and you have all information similar to your opponent, yet you overlook something or you didn't see something and you lost. 100% responsible. So, if that's the case, that's even more so in a stock market. If you made a decision to acquire certain stock and it went down in price, and now you are facing a situation what to do? Take a loss, go into something else, or keep that stock and hope that it will recover and will go higher in price where you bought it and you will sell at the profit. What to do? That's an interesting proposition. Number one thought in this case would be, let's see, you bought, or saying General Motors, which we already got familiar with that stock. Let's say you bought it at 650, it went down to a 550. Okay, so you bought 10,000 shares. Okay, so you're losing now $10,000. That's okay. Now, let's see if you didn't initiate this position and you're looking at the stock, General Motors, and it's 550. Would you buy that stock today at 550? What are the reasons for you to do so? If you find good reasons to buy stock today at 550 and you believe that it will be eventually a winner, and you are satisfied with fundamentals and with trading patterns and financial conditions of economy and everything else, maybe it's not so bad to buy it at 550. If that's the case, then keep the stock, don't sell it. So you have $10,000 of paper loss. It's still paper loss until you realize that and sold it. So you still keep it. If you have a reason to purchase more shares and you have possibility to do so, maybe it's a good strategy even to acquire another 10,000 shares now at 550. So your average is now $6. But only in the case that you found appealing reasons to purchase more shares, or not even more shares, just simply, let's say you have none of any shares of General Motors, General Electric, and, oh, by the way, maybe you should buy General Motors instead, but it's another story. Okay, so if you have General Electric, is good for you at 650 and it's still good, so it's even more appealing to you at 550. So then go and buy more shares. However, practice really tells you and me that once you get loss of 7% from your initial investment of capital into any single security, you have to sell. Unfortunately, you have to sell. So with General Electric, you should have got out of stock well before it reached 550. So you bought it at 650. So what's the 7%? 650. 650 multiplied by 7? Oh, it's what, 45? So 45 cents. So you should have been out no later than it reached $6.05 or so. But you know what? Okay, so you were not fast enough. So you sold it at $6. That's what you should have done. So now at 550, okay, you can jump in again. Again, only if you believe that it's now a good or better investment. Now, let's discuss the first, second, and third rules of investment. It is preservation of capital. Rule number one. Rule number two, preservation of capital. Rule number three, preservation of capital. That's the only thing what you care. You can't lose money. It's impossible for you to lose money. So what you have to do not to lose money? You have to be extremely cautious about initiating new positions. Your choice of investment is number one quality that you might possess. So it's choice of investment, it'll also timing of investment. So if you figured out that General Electric is a solid investment that will not lose you any money, how would you do that? What makes you so sure? Well, you read a little bit about General Electric, what it is, what it represents. Now, don't read a lot. Number one, you will not understand it anyway. Number two, even if you will read a lot and you understand everything, what will happen is that you will know just as much as all other traders. So, what's your edge? There is none. Leave it to them, to professionals, to read all the information and study. Because in the long run, it means nothing. General Electric just recently, not so long ago, was probably 36, some 35, $36 a share. And today you can have easily, I think today it's trading at $7 and 20, 25, 30 cents or so. So what do people do who bought it at 35, $36 a share? They were taken to cleaners. Guess what? They lost all their capital by holding on to a stock. They fell in love with General Electric. It's a fantastic company. It's a great company. It's probably the oldest Dow Jones stock, if I'm right. Yeah, I think so. So now there is a lot of derivative instruments that you will need to learn, understand, and use it in your trading. So what's happened? What we talked about today? We talked about selection of stocks. Remember, we started with the book about Jesse Livermore, supposedly the greatest trader of all time. Now, the foreword to this book, it was annotated edition by John Markman. I followed him. He is a renowned specialist who has several slots on CNBC and many other programs. And among other things, he's writing so-called Markman reports by the name The Power Elite. I'll show you how it looks. I found it extremely useful newsletter, and in each newsletter, it's published once a month, he showcases one or two stocks which he recommends. And at the very last page of each report, he shows our elite position table, where he talks about stocks, when it was acquired, date, buy price paid, and current quote. Where is it now? Most of his investments are in plus. In plus, there is a percentage gains or so on. It's a very detailed newsletter which I'm following. definitely helps you. It doesn't mean that I'm buying every his recommendation, but at least it gives me information to work with. And if everything's satisfactory, most of the time it is, I follow his advice. Um, he also writes it's very interesting observation of the total market. Here is very interesting what he wrote just last March. Professional money managers are at it again. They're trying to shake small investors out of the stock market, writing gloomy reports, sending surrogates to flood the airwaves with misinformation about a pandemic that could be unlike anything we have seen before. The process started in late February. Market watchers at Goldman Sachs began telling their institutional clients and investors are underestimating the potential impact of coronavirus. Peter Oppenheimer, the Goldman analyst, wrote that the corporate earnings are vulnerable because precautions to quarantine the infected are leading to widespread closures across Asia. So far, about 70. Okay, I'm not going to read the numbers because obviously they're outdated by now. So you can imagine the level of panic that would occur in the United States if President Trump told everyone in New York City and Los Angeles they were not allowed out of the house. It would seem like the end of the world. That's a heck of a pitch. The media, as usual, is playing up that angle. Investors are overreacting too. Pandemic is a scary word, and the fear tends to cloud rational thoughts. This is all by design. Professionals want smaller, unsophisticated investors to be disoriented. It creates buying opportunities for them. The media is complicit in a useful idiot sort of way. Negative headlines push clicks, attract eyeballs, and sell newspapers. And professional doomsayers, cloaked in their professional tweed jackets, are all too happy to oblige with the scary soundlines. Yeah, of course. Yeah, markets these days are highly manipulated. That's why the old strategies like Warren Buffett's hold on to Coca-Cola or American Express stocks for last 500 years. No, sorry, I'm mistaken. Probably 50 years. And it doesn't work anymore. That's why all kinds of day traders can show way higher results than Warren Buffett. However, Warren Buffett will survive. I wouldn't worry about him. But there are a lot of forces are against you. So although I'll have to start next program with options, because with options to understanding them, really it's a waste of yours and my time. You will never get anywhere if you believe that you can buy a stock and it will go up 100 times and you'll make all kinds of money. Uh, I can't help you with that. I think you need to see your psychiatrist most likely. I'm not a great help in this respect, but consistently make reasonable gains with very little risk, that I can think maybe I will be able to help. Not all of you, but some. And if that's happened, I will be a very happy man. Thank you very much, and see you next Wednesday at 1:30. Thanks a lot. Bye bye.
Wow.
Okay. Okay. So what do you say?
I love it, and I don't want it to end, and we're still broadcasting because I just want people to know how much this is a lot to learn. And we are so blessed and fortunate to have somebody of your experience willing to share the real life experience of doing this. And, the first thing we need to do is get that book, right? Do your homework and have your questions ready for Sasha next time. What do you think, Sasha?
Yes, I'd love to answer any questions, whatever will come along. It's just when I was preparing to the show, I started to think how complicated it is. It's very complicated even for me. Every position that I initiated, I'm taking a lot of information and I'm studying patterns and so on. But you know what? See, the thing for me, it's not a work for me. It's a great pleasure because I like to see different options and different possibilities and say, okay, even like if you want to choose to buy General Electric or General Motors, what's a better choice? So you have to spend some time and